High yield dividend warriors. It is time to talk about the annual SCHD reconstitution. It just happened here. Let's talk about what this fund did, and let's get my reaction to it as I'm going to be reacting to all the additions and deletions and my overall thoughts on what SCHD is doing. All right, guys, so this is a little visual aid that they have provided us. Charles Schwab, one of the best fund providers out there. This also has to do with their International Dividend Equity ETF, which is known as SCHY. But we're going to be primarily focusing on SCHD here. The reconstitution process for the Dow Jones U.S. Dividend 100 Index, this is the index that they follow, implemented changes on the Monday following the third Friday of March each year. All you guys need to focus on is that this has already happened. So in 2025, the event happened on March 21st. So the objective of the annual reconstitution is to continuously apply the index methodology, and when they're picking their stocks, guys, they are going to be putting emphasis on higher quality companies with a consistent track record of dividend payments. They actually pick companies that actually make money. They actually have real profits. They're not harvesting Bitcoin and have tokens and are hoping to give you back your own money and call it a distribution or a dividend. This is an actual pure dividend cash payment from actual profits. Don't get those two confused. This is a real man's ETF. The index constituents are reweighted quarterly based on a float adjusted market capitalization approach. So remember, guys, there are different metrics to get into this fund, and not every stock is the same, right? There's going to be large companies, there's going to be small companies. So those get weighted when they get put into SCHD based on their market cap. SCHD or SCHD index focuses on the sustainability and the quality of dividends by screening companies based on 4 different quality attributes. This is to make sure that the companies that they're actually holding are worthwhile. I know a lot of dividend investors out there, they're just going to a stock screener and they're just putting under dividend yield, they're just putting highest to lowest, and then they're just picking the stock that pays the highest in dividends. That is a very poor way to be selecting companies. That will not lead to long-term success. There's plenty of dividend traps out there, plenty of companies that aren't actually making money, but are still somehow paying you a dividend either through your own money in the form of return to capital, or they're taking on debt to be paying you dividends. Now, SCHD has all these different criteria, these different metrics. They're screening through companies that are giving them the best dividend yield and also other factors in here. So let's talk a little bit more about them. So the first one is the cash flow to total debt. This is really just making sure that the company can pay off their future debts. Of course, we should always be looking at something as important as that. Want to make sure these companies are healthy and can continue to keep not only paying us, but all the different people that they do business with. Then they also take a look at return on equity. This is how efficiently are they actually using the shareholder capital. We want to make sure that they're efficiently being good stewards of our money. And of course, there's the big one that you really care about, the dividend yield. Of course, we always want the biggest, juiciest dividends, but we don't want that to come at the expense of the overall company. And then this is another big one that often gets underlooked, is really underrated here, but that is the 5-year dividend growth rate. And this is actually super important because we not only want companies that have high dividend yields and good sustainability, dividend sustainability, but we also want companies that are consistently growing their cash flows and net revenues and profits, because that's going to allow them to be giving out more in dividend payments every single year, and thus we're going to have a higher dividend growth rate, right? Inflation, it will unfortunately just keep going up and up in life. So if we're just constantly getting around the same 4% yield every year, that's not going to help us. We want that dividend to be growing every year to keep up with inflation, to actually be outpacing inflation. It's truly the 8th wonder of the world to see your money compound and just keep getting bigger and bigger. That dividend snowball continues to get bigger. All right, guys, so just some fundamentals about what happened with SCHD. So their free cash flow to debt, it actually went from 59 to 66. What this essentially means is that for every dollar of debt the company has, it's going to be generating either 59 or 66 cents in free cash flow annually. So the higher the percentage here, the better the company's ability to cover its debt obligations from the cash that it generates. Generally, any ratio above 50% is usually seen as healthy. That's going to suggest that the company actually has a really good ability to generate cash and service its debt for the future. Of course, that's going to depend on the industry and the particular company. So everything's looking pretty good there. The return on equity dipped a little bit, but 46%, 47% is still pretty good overall. The dividend yield also fell a little bit, about 13 basis points, but the dividend yield is constantly changing every single day that the stock market is open, so I wouldn't pay too much attention to it. Getting nearly a 4% yield with the high quality companies that are in SCHD, that's a win in my opinion. And then we got the dividend growth. This is something that's huge, is that went from just under 8% to now about 8.4%. So that's huge. The companies that SCHD is holding is constantly giving dividend raises, giving big fat payments to its shareholders. We'll talk about a little bit more about that here coming up. All right, then we get into the real meat and potatoes here, guys. These are the actual companies that SCHD added, and then the ones that SCHD deleted here. So the reconstitution actually resulted in the deletion of 17 existing stocks and the addition of 20 new stocks in SCHD's index. So when we talked about those metrics before on the prior pages, they're basically funneling out all the companies that pay dividends that are US based on their metrics. These are the 17 that got removed and the 20 that got added based on their algorithm. Now, I always see a lot of people saying, oh yeah, the fund managers of SCHD, they wanted to be more aggressive or they wanted to do this, so that's why they did that. That's not true at all, guys. SCHD is not actively managed. It's passively managed. It follows an index. That's part of the reason why the expense ratio is so low, is that it's not being actively managed, and that's generally been a good thing for SCHD's history, right? It's been around since 2011. It's done very well, and part of the reason is because it's not putting any emotion into it, which you would get when you see a lot of active trading. It's all passively being managed on an algorithm, but it's based on an amazing metrics. So let's talk a little bit more about the companies that got added and deleted. So there was a total portfolio turnover of 20%, which is pretty big, right? If you think about that, every 5 years, assuming that it continued to have 20% portfolio turnover, you'd be looking at basically a completely brand new fund potentially. All right, so some of the biggest additions and deletions that they wanted to know are ConocoPhillips. This is an oil and energy company. They are actually the biggest addition to this fund. They now are just under 5% of the total SCHD fund, and they pay a 3.5% dividend yield. So just note this, guys, you have to be very comfortable with these companies if you want to continue to hold this particular fund. Another big one is the pharmaceutical company Merck, which is now 4% of the portfolio. Brand new ad there. Then we have a lot more additions on here, but none are super material. We have the whole good old Schlumberger, or whatever the heck it's called, another energy company at 2.3%. Target, big retail company at just around 2% as well, but these are pretty big dividend payers around that 3%, 3.3% mark. General Mills is a food company. ADM is also another company that helps in the production of food. So those are some bigger additions to the portfolio. And then we get even more energy companies in Halliburton, and these are the additions here. Even some of the bigger dividend yields, FMC Corp at 4.77% dividend yield, that only makes up just 0.21% of this fund, so not very big at all. So it's getting a pretty big dividend yield, but there's probably a reason why it's such a small portion of the fund, right? Probably a super small market cap, or it just didn't do good in some of the other metrics. Again, this is weighted based off market cap, so that's what has it at such a low percentage of this overall fund. And some of these are just super insignificant. We got First Financial Corporation, of course, a financials company at just 0.02% of the fund. That is essentially immaterial. They're also giving a 4% dividend yield. So some addition. Let's talk a little bit about the deletions as well. The biggest one is Pfizer. It used to be 4.3% of the fund, and now it has completely disappeared. You'd say the blood of Pfizer is no longer flowing into SCHD. Man, I'm glad that Pfizer's only out of SCHD and not permanently out of our lives, right? So that's a big blow in the pharmaceutical industry. And then we also have BlackRock, which was just under 4% of this fund. Financials company, wealth management, ETFs provider here with BlackRock. And they had around a 2% yield, but that is no longer part of SCHD based on the metrics, the algorithm. it no longer had a home here. Then we get some other financial companies getting dropped here. That's going to be another common recurring theme. You got U.S. Bancorp, M&T Bank. These are all getting dropped. Huntington Bank shares also got dropped. So a lot of financials you'll see on this list, and as well as consumer discretionary. That's basically every single industry in the deletions. One more industrial and C.H. Robinson, and then of course Pfizer. So lots of deletions in the same areas. So this just kind of summarizes what we just looked at. So again, consumer discretionary and financials had a lot of companies get dropped. So SCHD as a whole now will have less of those two particular segments. But then they also added a lot of energy companies. They added a lot of consumer staples companies. And they also, I guess they netted out. So with the financials of adding 5, so that nets to losing 4 overall, but still a pretty big loss there. So when you look at this, you need to be comfortable with energy companies. So just like oil, gas, and renewable energy companies, energy can definitely offer a strong return because it's always going to be in demand, right? As the global economy continues to grow, so too does that need for energy. And that could really lead for increased profits for these particular companies. And these oil companies, they're known for one big thing as well, and that's that they pay a lot in dividends. So us being a shareholder now in more of these energy companies, that's more dividend payments that are coming our way. Super excited to see that. However, there's also, of course, going to be cons. Energy companies come with risk. They can be extremely volatile. They can definitely be impacted by geopolitical events like we're going through right now, tariffs, all that. People might say we go to war for oil. Again, guys, oil definitely has some pros and some cons. Just be aware of that. And then of course, there's consumer staples. So consumer staples are companies that make products that people buy regularly. This could be like food, drinks, and household items. So they're always going to be in demand as well, no matter how the economy is doing, right? If your economy is doing good or bad, you're still probably going to buy toothpaste, shampoo, body wash. Of course, I'm hoping everybody's buying these things during rough times like we're doing right now. I know maybe not getting your Misty dividend payment, you might not be able to buy household items anymore. So the rest of us, I hope, are doing just fine. And then, of course, there's going to be some cons investing in consumer staples. They generally are pretty mature companies like the Procter & Gamble's. They're not going to offer huge growth opportunities, right? Nobody is coming up with a revolutionary new way to clean our bodies. There's no AI component to it, so probably just smaller growth overall there. Again, it is very stable, so that's something you also gives you peace of mind as well. And then we did see that there was a drop in financials, so just know some of the pros investing in financial companies is that companies like banks, insurance companies, investment firms, they can generally offer strong returns because they do play a crucial role in this economy. As the economy grows, the demand for those financial sectors, getting those loans, those mortgages, those insurance premiums. A lot of these financial companies, they love to spread the wealth. They're going to share some of those profits with us. But on the downside, these are super volatile and are based off of economic cycles. When the economy is struggling, there's going to be a financial crisis. These companies can lose a lot of money like we saw during the last financial crash in 2008. And then, of course, there's interest rates and government regulation. So a lot of things that are not even in these financial companies' controls. So those are just some of the big industries where we saw lots of fluctuations. Here's just another table that goes over it. So energy overall is now weighted nearly 9% more, which is a huge, substantial change, guys. That's what you need to be comfortable with, is that there's going to be more energy and there's going to be more consumer staples. And on the flip side of that coin, there's going to be less healthcare at slightly at negative 2.1%, and there's definitely going to be less financials at negative 9% just about. So you really need to be comfortable with what's going on there. SCHD, super small expense ratio of just 6 basis points. You guys want to know what I think about SCHD's changes? Again, 20% portfolio turnover is pretty material. And my answer is going to be kind of shocking. What I think about this change is that it does not matter at all, guys. What actually matters is this part right here, the dividend quality. What matters is the metrics, the algorithm that SCHD is using. Because I know every single year, SCHD is going to change, right? When I first started buying SCHD in 2022, it looked completely different than the SCHD of 2025. What you need to love or Dislike is the metrics, is the algorithm, is the methodology that SCHD and Charles Schwab are using. What you're seeing right here with the ads and the deletes, that doesn't matter. You have absolutely no control over this. What you do have control over is putting your money to good use. You are hoping that these funds are good stewards with your money. You're hoping that their dividend ship pays off. They are paying you in dividends. They are helping you slay the dragon, guys. I do not care about an addition of Merck or a deletion of BlackRock. That's not going to keep me up at night. What's going to keep me up is that I've invested my money in solid funds that are using good metrics, good methodologies to continue growing my money. And come 2026, we're going to see this again, guys. There's going to be probably another 20% portfolio turnover. There's going to be additions. There's going to be deletions. And that's okay because I trust SCHD for its strict criteria to get the 100 best dividend paying companies in the fund. Just real quick, guys, we can see the holdings breakdown by sector. Energy now is definitely leading the way. Consumer, defensive, healthcare, industrials all make up over 10%. We can see the top 10 holdings here. ConocoPhillips, 4.59%, Chevron at 4.4%, Verizon 4.07%. So some oil, telecommunication companies, and then we have the good old reliable Coca-Cola at also just around 4% as well. Pharmaceutical company here in Bristol Myers Squibb. Altria, of course, we all know the good old smoking company at 3.83%. Tobacco. Technology company in Cisco, surprisingly pretty high on this list, but that, again, it's weighted based on market cap. Amgen, another pharmaceutical company. AbbVie, another pharmaceutical company. So the top 10 alone make up just about 40%. So that's pretty standard with what it's been like in previous years. And overall, you're getting exposure to 104 great paying dividend stocks. I will come out with yet another update video on SCHD that goes into way more detail about the fund overall. Just wanted to give a video on all constitution changes because there were some pretty big ones. I do think this is a way to continue to slay the dragon in 2025. It's a map to almost guaranteed success, I'd say, because just based on SCHD's fantastic track record and algorithm, it's a way to learn new spells and become a high yield dividend warrior. Want to see how many shares of SCHD I own and my full stock portfolio? Check out the Patreon link below and join the Discord for more great conversations.
Don't want to be part of the matrix. We don't want to be part of the system. Not only unplug, we want to fight the dragons. And you don't want to fight the dragon naked.